Welcome back, everyone. I am so incredibly glad you're taking the time to invest in yourself today. In our previous lessons, we looked at liquidity, which basically answers the question, hey, can we survive today? And we looked at activity, which asks, how efficiently do we run our day-to-day operations? But today, we're arriving at the absolute engine that drives long-term business survival and shareholder value. We're talking about profitability ratios. Okay, let's dive right into this explainer. Here's our blueprint to completely conquer margin and return-based ratios on the CMA exam. We'll cover the profitability engine, take an income statement margin walk, compare return on assets versus equity, break down the DuPont analysis, and wrap up with 4 golden exam rules. Kicking things off with Section 1, the profitability engine. I want you to think of a company kind of like a patient walking into a doctor's office. While liquidity might represent a steady pulse, profitability, well, that represents the long-term health and vitality of that patient. Without profitability, shareholder value essentially just dies. To measure this health, profitability ratios ask 2 really fundamental, foundational questions. First, out of every dollar of sales we bring in, how much actually makes it to the bottom line? And second, how effectively are we generating profits from the capital that was invested by our stockholders and creditors? Every single formula we're going to explore today answers one of these 2 questions. Let's move on to Section 2, the income statement margin walk. To really master our sales-based margins, I want you to imagine taking a physical walk right down the income statement from the very top to the very bottom. At each stop on this walk, we're going to measure what profit remains relative to our net sales. It's basically a cascade, stepping down bit by bit. We hit gross profit margin first, pass down to operating profit margin, and finally reach to bottom with net profit margin. Let's see how this builds. So stopping at our first step, we have the gross profit margin, which is calculated by dividing gross profit by net sales. This strictly measures our production efficiency and our pricing power. It is literally the front line of profitability. If pricing suddenly drops because of fierce market competition, or say direct material costs suddenly rise, this top-level margin shrinks immediately. Just think of a company like Apple. Their massive gross margins come from immense pricing power. Contrast that with, a local grocery store, which operates on razor-thin gross margins and relies on sheer volume just to survive. Walking further down the statement, we move past operating expenses like administrative salaries, marketing, and rent to reach the operating profit margin. We calculate this using operating income, which you might know as EBIT, earnings before interest and taxes, divided by net sales. I absolutely love this ratio because it evaluates core business operations while completely ignoring the effects of financing choices like interest or tax strategies. It isolates pure, unadulterated operational performance. Let's see what the data reveals as we move even further down. Finally, we hit the absolute bottom of the income statement, the net profit margin. That's net income divided by net sales. This reflects the final residual earnings. It's exactly what is left over after all expenses, cost of goods sold, overhead, interest, and taxes are completely covered. As a future CMA, this is the ultimate metric your CEO is going to be staring at during earnings calls. Now, I need you to pay very, very close attention to this next concept because it's a classic ICME exam trap. The exam is going to ask you, why did net margin change when gross margins stayed flat? I want you to immediately realize that if the top of the statement didn't change, but the bottom did, the answer absolutely has to lie right there in the middle. The culprit will always be a shift in operating overhead, a change in interest expense, or a change in taxes. Don't let them trick you on that one. Moving into Section 3, return on assets versus equity. Let's transition away from our sales-based margins for a second and talk about capital-based returns. We no longer just want to know profit per dollar of sales. We want to see the profit generated per dollar of invested capital. Now, what's really fascinating here is the contrast between 2 heavyweights that are heavily tested on the CMA exam. Return on assets, or ROA, looks at the entire pie of capital, while return on equity, or ROE, zeroes in strictly on the shareholder's slice of the pie. Let's define return on assets first. ROA measures how effectively management uses all capital assets, which are financed by both debt and equity, by the way, to generate earnings. The formula is net income divided by average total assets. And please remember our average rule from the activity module, because net income comes from the income statement, which represents a period of time, and total assets comes from the balance sheet, which is a snapshot in time. We're basically mixing oil and water. You must always use the average of the beginning and ending assets in the denominator to smooth that out. But before we calculate ROE, we've got to address something absolutely critical. If a company has preferred stock, you must subtract preferred dividends from net income in your numerator. Preferred shareholders act almost like royalty, right? They get paid first. Their dividends do not belong to the common equity holders. If you forget to strip these out, your calculation is going to be completely wrong on exam day, period. With that trap successfully avoided, we can safely calculate return on equity. ROE is net income minus preferred dividends divided by average total equity. This measures the exact return earned specifically for the residual owners of the business, the common shareholders. This is the true measure of what the actual owners of the business are getting back for risking their hard-earned cash. All right, on to Section 4, the DuPont analysis. We are about to dissect ROE the way an MRI finds the root cause of a patient's symptoms. So why do we need the DuPont analysis? Well, imagine you see a company's ROE jump from 10% to 20%. Is that good news? You might initially think so. But an increasing ROE isn't automatically a victory. It could be jumping because the company is selling incredibly efficiently, or it could be jumping because they took on a dangerous, highly risky amount of debt. DuPont breaks ROE wide open, so we can discover exactly what is driving that number. Let's look at what the math actually reveals here. The original DuPont model is a three-step formula. We multiply net profit margin by asset turnover by the financial leverage multiplier. What I love about this is the pure mathematical elegance of the whole thing. When you multiply these three specific fractions together on paper, you'll see that sales and assets completely cancel each other out algebraically, leaving you with exactly net income over equity. You are right back at ROE, but now you have three distinct windows into the company's financial soul. Window number one is our familiar friend, the net profit margin. We already know this is net income divided by sales. In the context of DuPont, this component tells us about the company's operating efficiency, or its pure profitability. Simply put, how well are they controlling their expenses relative to their revenues? Window number two is asset turnover. That is sales divided by average assets. This shows us asset efficiency, or volume. Basically, how well are the company's assets actually generating sales volume? A high turnover means management is squeezing every single drop of sales potential out of their equipment and inventory. And window number three is the financial leverage multiplier, which is average assets divided by average equity. So the crucial point here is that this reveals the company's hidden financing strategy. If a company has massive assets but very little equity, it means they bought all those assets with debt. A high multiplier pumps up your ROE, sure, but it also screams high financial risk. It acts a lot like financial steroids. Now, discovering this brilliantly illustrates a major shortcut for you on exam day. If you look really closely, the first two parts of DuPont, net profit margin multiplied by asset turnover, actually equal return on assets. Because of this, you can simplify the three-step formula right down into a two-step formula. ROE simply equals ROA multiplied by the financial leverage multiplier. Seriously, memorize this shortcut. It will save you precious minutes on the exam. Let's wrap it up with Section 5, 4 golden exam rules. We've covered a tremendous amount of ground today, and I am just so incredibly proud of the hard work you're putting into this. To make sure you survive and thrive on exam day, think of this summary as the ultimate screenshot moment for your mental notes. Rule 1, always isolate operations using EBIT over sales to remove tax and leverage effects. Rule 2, you absolutely must subtract preferred dividends from net income for ROE. Rule 3, always use the average for any balance sheet denominator to match your income statement numerator. And Rule 4, whenever a question asks you which specific driver caused a shift in ROE, deploy the DuPont analysis immediately. So, here is my challenge to you. Are you ready to tackle the test bank right now? Don't wait. Take a deep breath, head over to your practice questions, and run through 10 profitability and DuPont questions right this second, while these formulas and concepts are absolutely fresh in your mind. But as you do, I want you to ask yourself a deeper question. Is profitability just about making money, or is it truly about the art of manipulating margins, turnover, and debt to create wealth out of thin air? Think on that for a bit. You have the blueprint, you have the engine, and you know how to navigate the traps. Keep up the incredible work. Keep pushing forward, and I'll see you in our next explainer.